Hello and good afternoon, everybody. Thank you for joining us today. My name is Erich Patten. I'm the Chief Investment Officer here at Cutler, and we're joined today by Joseph Liu, a chartered financial analyst and portfolio manager. He's based in our Orange County office.
Hello, glad to be here.
Thank you for being here, Joseph, and for sharing your knowledge with all of us. Uh, we're going to look back on the first half, specifically the first quarter, but a lot of this conversation will be about the first half of the year. We asked the question, is there more to this market than artificial intelligence? At times in the first half of the year, it seemed as if there was not more to this market. Then we're going to look forward and try to see where the market goes from here. What are the major investment themes? What is Cutler looking at? We're expecting to take around 35 to 40 minutes of your time this afternoon. So if you'll bear with us, we'll get started right away. First, as we always do, we begin with disclosures. So let's let my computer catch up to us here. Ooh. Oh, I stopped the screen share. Let's go back to disclosures. All right. The important part of these disclosures is that as we say in our business, past performance does not indicate future results. And what that means to me is that we make the best decision we can with the information we have available today. But especially in this day of AI, information is coming fast and furious. The market is changing day by day. And Cutler, we do adjust our views accordingly. We try to anticipate what we see happening. But as new information becomes available, we do change those views and change our viewpoints. So always, please reach out to your financial advisor, have conversations about what we're talking about. How does it impact you? And how might changes to those viewpoints also impact you going forward? But Joseph, here we have our quilt chart. We always start with this quilt chart. Year to date, these are the first half numbers, not the second half numbers. What jumps out to you? What are the numbers that you think are most meaningful to share with our clients today?
Yeah, so this quilt chart is ranked from the highest returning asset class, and it sort of goes down, and the lower returning asset classes are at the bottom. And what you'll notice is year to date, emerging markets is the leader of this pack. And that is a shift that we saw a little bit in 2025. And this is a part of a larger shift away from large cap growth stocks, which are essentially large US technology companies. But what's important to note is that there's a couple other asset classes that are sort of climbing their way up in terms of stronger relative performance. And those are essentially smaller companies, smaller capitalization companies, going down to mid cap as well as large cap values. So, 2026, the first half, especially this last quarter, I characterize it as a rebound and then a shift within the market. And we're going to go into a little bit more about what really drove the market and why specifically emerging markets is number one this year so far.
Yeah, Joe, before we jump into that, I do want to highlight bonds were really an anomaly on this chart. You can see the bond return nearly flat in the first half of the year. We're going to talk about that when we get into the market risks and really dissecting what's happening with interest rates later in the presentation. But let's look at emerging markets. Back to our theme of the day, artificial intelligence. Look at this semiconductor chart. How do semiconductors and emerging markets, how are those related?
Yeah, so semiconductors, what you will find as you run the performance attribution of the indices is that this was a semiconductor rally. Definitely within the second quarter, that was very pronounced. And emerging markets, specifically countries like Taiwan and South Korea, are the primary manufacturer of logic chips as well as memory chips. So a lot of the emerging market rally was in fact a semiconductor rally as well. Um, Semiconductors now have a record share of the S&P 500 as shown in the chart on the right, and they account for close to 20% of the S&P 500 as of June 2026, which is a record share that we've not seen before.
Yeah, Joseph, by at least one measure, that 20% of our economy being tied to semiconductors, It might feel like a risk. It might feel oversized to a lot of people. I think back to when I started at Cutler over 20 years ago, and that was roughly the size of the energy industry, right? So it is very common for our economy and the stock market to reinvent itself, to see new leadership. 20% isn't necessarily a bad thing. That is a portion of our stock market that's doing very well. We'll talk about the earnings that are supporting this. Let's look at semiconductors versus the Magnificent Seven, though, and how we've seen a shift in leadership. Joseph, this is really a phenomenal chart to look at. Over the last, really since COVID, Magnificent Seven stocks have led the market higher. Those are the big tech companies that we've all grown so familiar with, and you can see year to date, they're negative overall. While the semiconductor index is up 100% through June 30th. Sold off a little bit since June 30th, but still up very strongly on a year-to-date basis. And this new leadership really has led to a new dynamic in the stock market. And Joseph, talk to us about this next slide. I think this really shows what's happening kind of on a fundamental perspective with this shifting trade.
Yeah, so let's go into some of the Mag 7, of which most of those are hyperscaler companies. So as we all know, AI is playing a bigger and bigger role within our lives as well as the broader economy. And most of the Mag 7, a lot of them are what are considered hyperscalers, which are essentially the companies that are responsible for this build out of artificial intelligence. And on the left-hand side, it shows the capital expenditure of these hyperscalers, namely Oracle, Meta, Alphabet, Microsoft, and Amazon. And as you can see, in 2026, they're on track to double the capital expenditure amount that they had in 2025. And that's expected to increase in 2027 and 2028 to close to $1 trillion for each one of those years. It's an incredible build out. It's a lot of money spent. And in some ways, these hyperscalers are sort of building the infrastructure, the data, the energy, the computational power that is the foundation of artificial intelligence and the benefits that we see in artificial intelligence. Now, on the right-hand side, we have the free cash flow of hyperscalers versus semiconductor manufacturers. And you can see in, we'll call it 2025 or so, that line crossed over as these hyperscalers start spending more and more money on building out these data centers and the infrastructure. They essentially transferred all their cash flow over to these semiconductor manufacturers. It's almost a one-to-one comparison, and we're seeing more and more cash move from the builders of AI into the producers of the chips and the silicon and the actual nuts and bolts that make up the compute.
Yeah, Joseph, I see the symmetry of this chart really is amazing to look at. But when I see it, I kind of come to two different conclusions. One, the conviction of the hyperscalers in this new technology. $1 trillion is an immense amount of money, and the belief that this technology is going to change the world is really backed up by this incredible investment. And then the other, I guess, conclusion I would make from this chart is that the rally in semiconductors is based on fundamentals. You're seeing money flowing into that sector. It's lifting the S&P 500 higher. The next leg of the market, though, might have to come from different leadership, right? As the free cash flow of these hyperscalers has been targeted for that semiconductor build out. What then happens to the next phase of artificial intelligence? We'll talk a little bit about that as the presentation moves along. But there was another story in the first half of the year, or really the second quarter, that we want to touch on before we transition to the next part of our presentation, and that's the IPO market. And we had an IPO of Space Exploration Technologies, Elon Musk's space company, in the first half of the year that was unlike anything we have ever seen in the stock market. In fact, he raised $75 billion through an initial public offering, an IPO, in June. And that 75 billion dwarfs the second largest IPO ever, Saudi Aramco. And we don't want to get into kind of the individual stock. Should I buy? Should I not buy? There was an incredible amount of retail investor interest in this stock, unlike any I've ever seen in over 20 years at Cutler of of people really paying attention to what's happening with this IPO. But what we want to point out is the risk appetite out there. This really does demonstrate that investors are bullish on the future. They're bullish on new technologies, and it's not just SpaceX. We highlight on this page also a company called SK Hynix. SK Hynix is a South Korean semiconductor company. They've been public for quite some time in Korea. They decided to access US capital. So just last week, they issued $26 billion of an IPO here on the US market. That's the third largest IPO in history. Those US shares initially traded at a 40% premium to the South Korean shares. That creates some valuation concerns as well, especially when you can buy the same thing in Korea 40% cheaper. Uh, but the point that we want to make here is that the risk appetite is there. Investors are bullish on the future. We're seeing other companies like Anthropic, who's likely to go public in October. OpenAI has intentions to go public as well. So this IPO window, I think, is really demonstrating to the stock market and to investors a lot of confidence in where the economy and this technology is headed. So that's all good news. This is a kind of a very bullish start to our presentation, and we do want to give a balanced perspective. And we've talked about some of these concerns already this year, Joseph, but we do want to revisit them and see where kind of things stack up here at the midpoint of the year. Our first concern is it's an election year. Not that there's a concern that it's an election year, but just elections, midterms tend to be a more volatile part of the investment cycle. So we want to revisit that and see what the volatility has been year to date. Then we want to talk about the oil shock. We've all seen it at the gas pump. We've all felt it. What has that meant for the economy and the stock market, and where do we think we're headed from there? And then finally, and this is related to the oil discussion, we have a new Fed chair. We have a lot of focus on inflation. And energy has been a big source of that inflation thus far this year. So, Joseph, why don't you talk us through what's happening with the midterm election, especially in the second quarter?
Yeah, so if you take a look at the second quarter performance and compare it against the other second quarter performance numbers of midterm year elections, what you'll see is that 2026 is an outlier. 10 out of 19 of these second quarters during the election cycle were negative. And that ranges from a negative 20, 21% in 1962 to a positive 10%, with the median being about negative 1%, slightly negative. 2026 in the second quarter returned about 15%. And that is astounding. And that is something that I think although we always welcome positive returns, looking forward, we still do caution many investors that there still can be volatility within a midterm year. So we're very happy that we returned 15% in 2026, but it's always possible that we could see some political outcome that could generate volatility within the stock market.
All right then, Joseph. If we expect volatility, does that mean investors should sell? Sell in May and go away is a common phrase heard on Wall Street. Should investors be thinking with that mindset?
Well, I was gonna say it's certainly tempting, but it's close to impossible to time or to forecast exactly what the market's going to do on a short-term basis. And here's a chart of what typically happens during a midterm year. Within a midterm year, at some point in time, historically, there's been about a 16% correction, we'll call it drawdown from peak to trough within the year. Now, however, subsequently, once the political issues are resolved and there's more certainty in the market, there's oftentimes a rebound, and the rebound on average is as high as 36% after certainty has been established. So I would say like this is a case of where staying invested is very important, and in some sense we do have to accept a level of volatility to get the returns that we are anticipating within equity markets.
Yeah, as I look at this chart, I see that midterm, negative volatility is greater than any of the other years. But what jumps out to me is all years have volatility, right? That is normal for the stock market. The first year of a presidential cycle, minus 12%, minus 10.8 in the third year, minus 12 in the fourth year. That's the price of admission for investing in stocks. And that's why we invest into equities because of that equity risk premium. So trying to time the market, we think is not something we advocate at Cutler. We believe there's reasons to be bullish. We'll talk about where we want to allocate assets, but in terms of trying to guess the next move of the stock market, not something we think is in our clients' best interest. Let's talk about oil shocks and recessions, because we have avoided volatility this year, and it's not with a lack of negative news. In fact, the oil price jumped over really about 100% after the invasion, or not the Iran war or the Iran conflict. Joseph, walk us through what's happened with oil thus far this year, and then we'll talk about the stock market reaction and kind of what we've expected from that.
Yeah, so there definitely was a surge in oil, we'll call it start at during March, and that was an area of concern because the oil prices, or commodity surges are typically have been correlated with recessions as well as drawdowns within the stock market. And this is a chart that we created to demonstrate that. It's a little complex, but what's going on here is this is documenting each surge in oil, the amount that oil appreciated, and the subsequent movement in the S&P 500. And it's common, about 9 times out of 10, you'll see some sort of drawdown or some sort of recessionary activity occur when oil prices spike. However, one thing that we did note was that this behavior often occurs when we're closer to the end of the economic cycle. So typically during the third quarter of the economic cycle, you'll usually see a lot more commodity pressure, and at the same time you'll see declining earnings or decelerating earnings as well. And what's different this time around is that I would argue we're earlier in the economic cycles in which earnings are actually starting to appreciate. So what they found that is that in a situation where earnings are accelerating like we have right now, typically the oil shock does not affect the market or the economic cycle as pronounced in the situations that we've sort of seen in the past. So I would say that we do still want to keep our eyes on what's going on with oil, but as long as the earning train continues to generate what we've been seeing, the market will adjust. The market will find a way through this crisis.
Yeah, talking about adjustments, this slide really shows, I think, how markets can work, how capitalism can work when there's a profit motive to find solutions to various problems. And, we mentioned earlier that 20% of the S&P 500 are semiconductor stocks. That's because of innovation. It's because of finding that profit motive and companies innovating and creating new products. Here's how capitalism is responding to the Strait of Hormuz crisis. Saudi Arabia and the United Arab Emirates have both begun construction of pipelines to bypass that choke point. The UAE pipeline is currently estimated to come online in 2027. It's about 50% built already. In the meantime, governments around the world have been releasing strategic petroleum reserves at record paces. This shows on the right really developed markets releases from their petroleum reserves. We don't have China on this chart because they don't release that information, but it's believed that they're really on the scale of the United States. That has helped put a lid on the price of oil appreciation. That's helped the global economy. That's kind of helped the stock market along the way as well. As as we look ahead again, oil price increases are cumulative, right? And so this does generally weigh on economic growth. But if you look at the United States, the U.S. is a net oil exporter. So there's a mixed bag there. Consumers, yes, it hurts consumers in terms of higher retail prices at the pump, but there are regions of the country and businesses within the United States that benefit from those higher oil prices. So overall, it's a fairly muted response. We haven't seen the historical response from oil that one would expect given the historical record there. But what we have seen is an impact on inflation. And Joseph, I'm going to pause here and ask you a question. A new Fed chair arrives. How would you rate the Jerome Powell era? He was Fed chair since before COVID, saw us through that COVID period and after. And now that we've closed the book on the Powell chairmanship, what are your thoughts there?
Yeah, so I think as a general whole, I mean, Powell has done a pretty good job. Now, very unfortunately, I think what he'll be remembered for is his response during the COVID pandemic. And if you recall, during that time, the central bank took extraordinary measures to provide liquidity to the market, and we saw the Fed do certain things that were definitely historical. For example, the Fed during that period of time purchase corporate bonds. That's something that, we've never seen a central bank do. Unfortunately, once again, I do think Powell is going to be remembered for his extraordinary measures, as well as his mistake. You could argue in keeping these measures alive longer than they needed to be, and for his misjudgment on the impact that these measures would have on inflation. He very famously marked that inflation was transitory in after COVID, and that unfortunately has not proved out to be the case.
Yeah, Joe, I think we could do an entire webinar just on Fed policy, but we'll try to fit this section within the time constraints that we have today. I would agree with you. I think that overall Powell did an excellent job as chair, but he did really have one key mistake, and it's the mistakes that he'll be remembered for. Kevin Warsh is definitely aware of that misstep. Let's look at this is a word cloud that Joe put together for today's presentation. These are the words that Kevin Warsh has used. The larger the word, the more often he has said it. And you see price stability jumping out front and center there. Price stability is inflation. It is trying to, in his words, restore confidence in the Fed, restore that commitment. You see resolute commitment here, a regime change from a Fed that perhaps wasn't as focused on inflation. You see too high. He thinks inflation's too high, the 2% target. A lot of this is really what we would call hawkish rhetoric. We're seeing what one would expect as a dovish Fed, right? Jerome Powell came under a lot of criticism from President Trump earlier this year for keeping rates too high. One would have expected the nominee for the Fed chair position to support that position and be dovish, but Kevin Warsh has actually come in and surprisingly been hawkish. In fact, let's hear Kevin Warsh in his own words. We'll see if this video works here. But here's Kevin Warsh talking about Fed policy at a recent press conference.
Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The paragraph goes on to say, but to be clear, the Fed will deliver price stability. My own judgment is the committee spent quite a bit of time, not just in 2 days, but over iterations of a couple of weeks. That's what we're prepared to say about inflation, but the commitment to deliver is strong, unanimous, and unambiguous. And that's, I think, an important message. We've missed for 5 years, and we're going to fix that.
All right, so Joseph, what are your thoughts on that statement from the Fed chairman?
Yeah, Warsh is
Inflation.
taking a much stronger rhetorical approach when it comes to talking about inflation. And as you can see, even though he's talked about deliberation, he talks about the resolve of the committee and the commitment of the committee to achieve price stability. And I think the tone of this is substantially different than the comments that Powell would make at his meetings. So, I think there is resolve. I think it's also important to take into account the context of these statements of when Warsh made these statements, and that was in May 2026. And here is a presentation about the inflation, the consumer price index, and the components of the consumer price index when inflation had a bit of a surge in May and reached about 4.2% on an annualized basis.
Now
Obviously,
remember the Fed target is 2%. So 4.2 is drastically different, 100% different than the Fed target. And I think this explains really the shift in expectations. We started 2026 with an expectation of one or two rate cuts, and now the market has a significant bet on the next move being higher. In fact, the odds of getting at least one rate hike this year have increased to over 80% based on the Fed funds futures. So that is a change in expectations throughout the year. That's normally been a headwind for stocks. Actually, higher rates is typically a negative for the stock market. We've seen the strength of the stock market in spite of that shift between lowering rates and hiring rates. But the bond market has struggled this year and has, relatively flat returns because of that change in expectations. Now, Joseph, this isn't that clear cut, though. We have a slide here on inflation. What are you thinking the Fed is going to end up doing? This is really a struggle between inflation and economic growth right now, isn't it?
correct. So the Fed does have a dual mandate. They do need to make sure inflation is, under control. There is price stability, but the other side of the book is to ensure that there's full employment, and full employment is usually associated with robust economic growth as well. And what we see is that things have shifted since May in the way that markets always shift. And what has happened is what over here is a chart of implied inflation expectations built into the tips as well as inflation swaps. And even with our increase of oil prices after the ceasefire broke down in Iran, inflation expectations, according to the market pricing on inflation-related securities, has not picked up. And I think the reason why is we are seeing economic growth start to slow down a little. And if you can take a look at the Atlanta Fed's GDP nowcast, which is a real-time estimator of where GDP is now, it's fallen from about 4% or so in May and now reads at about 1.3%. And this is a function of the fact that we are starting to export less as the dollar becomes stronger, as well as shifts within the exporting economy due to some tariff effects. So, because economic growth is sort of slowing down a little, and second of all, the labor market, which did pick up a little, but revisions for the past couple quarters have gone down. The labor market remains rather sluggish. There's not a wide scale amount of firing, but businesses aren't really hiring either. So I think a combination of a sluggish labor market as well as decelerating economic growth is going to make the Fed more cautious on raising rates in the near term.
Yeah, I think the Fed is definitely in a little bit of a tricky situation. We do have higher than expected inflation, although there's reasons to believe that it might continue to move lower. But we also have a weak labor market. And I think what's not captured in this chart here is the impact artificial intelligence is having on the labor market. And we're going to continue to see displacement. We've seen it amongst recent college graduates, where the labor market has gotten very challenging. And it's the Fed's job really to make the full employment a reality. So raising rates is going to be very challenging. I would sum up this section uh, to say that Cutler believes there's some value in your fixed income here. If we don't think that the Fed is going to be able to realize all of these increases that the market is currently forecasting, that's really an environment where you might want to extend duration, be comfortable moving, money market positions into longer dated bonds, for example, to kind of lock in those interest rates. The 10-year Treasury is at about 4.6% currently. That's a pretty attractive interest rate in our opinion. All right, so looking forward, let's take some of these concerns and look forward. What is Cutler looking at for the rest of the year? Let's start off. This is a familiar theme for those of you who have watched a Cutler webinar, but we're going to talk about international equities. It's been a phenomenal year for emerging markets thus far. Part of that, yes, is semiconductors, but Joseph, what are some reasons why investors might want to continue to have some international exposure?
Yeah, so if you look at the trend of what's been going on amongst financial institutions, which includes central banks as well as commercial banks, these large financial institutions have been diversifying out of the U.S. dollar, and that's a trend that's been going on since the late 90s. But that's definitely accelerated in the past year or so, and it's to the point where we believe there may be a shift in the dollar cycle in which non-US assets start becoming more attractive. So on the right-hand side, we have the rolling 3-year annualized return of developed market equities versus US equities. And as you can see, there's commonly these cyclicality within the shifts between domestic and international equities. And given the trend that sort of is occurring and possibly accelerating, the dollar may get weaker in the foreseeable future, and that would be a tailwind for non-U.S. assets. We definitely have seen it in emerging market equities, and we believe that that will continue to broaden out to the rest of the non-U.S. Economic sector.
Yeah, and thinking about broadening, looking beyond growth has been a successful trade this year. Value stocks have outperformed growth stocks domestically, and we continue to believe that there is an opportunity there. When we say value stocks, oftentimes I think of consumer staples types of companies, industrials, telecommunications companies, and these are companies where we have not yet seen artificial intelligence be implemented into their business model. And as AI continues to gain in breadth throughout our economy, I think all of these companies are going to be focused on efficiencies and productivity gains associated with this new technology. The trillions that we are betting on this technology absolutely need to produce results in terms of that efficiency. And so I think that presents a great opportunity for investors as they look long term to think, how do industrial companies implement this? How are they going to benefit? What's the investment thesis or the investment opportunity there? We continue to advocate for the value piece, having a slice of value, a dedicated value in your portfolio. And then finally, Joseph, what about earnings? We've seen a remarkable rally, and the most common question is this a bubble? Earnings might suggest otherwise. There's a lot of support in the stock market currently based on earnings growth.
Yeah, absolutely. And what I will say is, as much as semiconductor stocks and tech stocks have moved up, I mean, this is not 2000 where a lot of stocks moved up on speculation or basically hope, right? There are a lot of earnings that are in the forecasts of many Wall Street analysts that we're expecting earnings to grow throughout the next 12 months, and that is going to underpin the strength of the stock market. It's going to it's going to give additional reason why equities would be one of the better places to be. Another thing to point out is that margins have improved over time. And so when I look at these two charts, I mean, this tells me that being an equity investor may not be is not a bad thing. There are a lot of positives to corporate corporate fundamentals.
Yeah, we've never seen earnings growth at the rapid pace that we are seeing currently. And on the left side of this chart, you really see a pretty high correlation between Wall Street forecasts of earnings, not stock prices, but of earnings, and the actual earnings results. So that does give us optimism for the future. Obviously, no guarantees, but there's reasons to remain confident in this artificial intelligence trade and the overall growth we're seeing for equities. So finally, we want to conclude with some action items from our perspective and how Cutler manages portfolios. The first is income. Cutler was founded as a dividend investor in 1977. That bird in the hand we think is still important for investors. We're big advocates of identifying income opportunities. We've talked about a couple in this presentation today. Diversification, I think that is the biggest theme of today's presentation. It's working. Go back to that quilt chart and look at the different investment asset classes, all that had a great first half of the year. We believe diversification not only reduces investors' risks, but right now diversification is also really not costing investors opportunities for returns. So maintain that discipline and that diversification. And then finally, we look at portfolios with an eye toward valuation. There's a temptation to rush toward momentum, rush toward risk, but we think long-term investors are going to be rewarded by kind of zigging when others zag, and look for those opportunities that are overlooked or those asset classes that may not be in favor today, but you have reason to believe they will be going forward. So with that, I just want to say thank you all for joining us today in today's presentation. If you have questions about anything we've talked about today, please reach out to either Joseph or myself. We're happy to have a conversation one-on-one with you. But also, we encourage you to talk to your financial advisor. Find out how what we're talking about is relevant for your portfolio and your situation. But thank you so much. We wish you all a great summer, and Joseph and I will do this again after the third quarter.